Good morning, my dear students. I'm Miss Tania. This is Accounting 3. Welcome to my class. I'm very happy to have you back. So remember, it's very important that you save the information on your computer or that you write down all the material that you consider important to review later. Okay, so make sure you have with you a pen or a pencil and your folder or notebook. And let's start. Yes, I know that we already studied this, so you probably recognize the picture and here the topic, financial centers. But to continue with the new class today, it's very important we review a little bit about these financial centers. But I'm not going to read or to explain this again. You can watch the last video one more time. That's okay, that will be great. So let's just remember something important. Here, there are some bold words like financial centers or financial institutions, the square mile. But my favorite one, the one that we're going to use like a lot, is this one, Wall Street. Okay, so when talking about financial centers, we immediately connect with the stock markets. Do you remember about this? Well, so I paste these two gifts here so you can remember what we're talking about. Basically, we're talking about buying and selling shares of companies on the stock market. Wall Street is the name of the stock market in New York, very famous around the world for these kind of activities that we can see here in the gifts, or like this one in the screens, the big screens we have here on the top. Okay, so once that we remember what a stock market is, we continue with our class today. Today we're going to talk about trading. Okay, so trading, it's other way to say commercial, to buy and sell products. That is trading. So I give you a product, you give me money. You give me a product, I give you money. That's a trading. Okay, when you buy and sell a product. And you know very well that a product can be touchable, like goods, or untouchable, like services. Okay, so we understand what stock market is. Now we understand what trading is. Let's continue with market indexes. It's very important we recognize that when we talk about indexes, we're talking about numbers. Yes, numbers, just like when you go to a book and you have an index. Okay, so if we read this section here, we're going to understand much better. If there is demand for shares in a company, for example, because it is doing well, demand means that people are asking for this product. That is demand. So the market, you know, the group of people, they demand for a product, they want it. So if there is demand for shares in a company, people want shares of this company, for example, because it's doing well, its share price goes up. Obviously, if the demand is good, price goes up. If not, obviously it's going to happen the opposite, its price goes down. The overall value of shares traded on a stock market, and that's why it was very important to review what a stock market is shown by an index. The plural of index, indexes or indices. Got it? Okay, so now that we understand about these numbers, the indexes, we have some examples here. Around the world, like in United States, we already know that the most famous stock market or financial center is Wall Street. We must understand that there are other financial centers, other indexes that measure how companies are doing around the world. So from now on, next time you find this abbreviations here, or these names that I'm going to explain in a minute, next time that you read or you hear or you see something like this, you will understand that we are talking about the value of a company. So the higher the price of the share, the better the company is doing. The thing is that each country has their own way to measure the companies. So how do you call this index? In London, you call it FTSE, or you can pronounce it FTSE. That's how they call it. The Financial Times Stock Exchange Index. So this one, FTSE, is the one that is going to be referred in London. So it's how they make the numbers to calculate the value of companies. Here's like the most common one around the world, New York. So they have 2 or 3 famous indexes, Dow Jones and NASDAQ. So here we have these two, Dow Jones and NASDAQ. Remember this the rest of your life. You are going to hear about this like forever. Okay, so when talking about the Dow Jones Industrial Average, or the Dow, especially long established all economy companies. After this explanation, I'm going to show you a video that explains a lot better the difference between Dow Jones and NASDAQ, and another one. Okay, so when talking about NASDAQ, this one, it's like quite of extremely important right now because this one is referred to high-tech new economy companies, which is happening right now around the world. Like companies with high technology, they are growing because all of us are using technologies to communicate, to make businesses, to study, etc. So by now, we already know these 3 indexes, FTSE, Dow Jones, and NASDAQ. How do you call it in Paris, in France? You call it CAC 40. How do you call it in Frankfurt, Germany? You call it DAX or DAX. How do you call it in Hong Kong? You call it Hang Seng. And in Tokyo, Nikkei. So here we have the 7 most famous indexes to measure the value of a company. So the biggest companies around the world are going to be measured under these indexes. How you calculate this? Each country, each index has its own way to calculate. I'm not going to explain you that. That's something more specific. Basically, it's something you're going to learn in finances if you're interested in working on banks or in the stock market. Okay, so you're going to learn about this if you specialize or if you study something related to finance or business or economics or something like that. This is interesting because it's going to help people to take decisions. So if the company is doing really good, people want to be part of the company. So people will buy shares. Remember that word, shares. If the company is going down, it's making very bad businesses, people don't want the shares and they start selling the shares. So it's going to be someone else's problem. Okay, so now that we understand this, I'm going to show you a video explaining these 3 indexes to measure the size, to measure how companies are doing. These are the most common ones, especially here in America. Because, you know, we have a lot of businesses with the United States. We know a lot about New York. We have seen movies. So Probably if you go to the newspaper, you are going to find a section in the economics section, something about NASDAQ and Dow Jones. And also, well, we're going to listen about Standard and Poor's. What's the difference? So are you ready to watch this video? Let's watch and listen, and let's understand better how they work. You'll see this is kind of, in the beginning, it sounds kind of complicated or difficult, but if you keep listening and if you pay some attention, it's kind of easy. I mean, I'm not saying it's like a piece of cake, not like that, but it's something that you can understand better, and from now on, you can have conversations with people from universities or with professionals about this, because now you understand what they are. If you're more interested on this, you can download applications on your cell phone that they're going to inform you, they're going to let you know how companies are doing around the world according to these indexes. Okay, so let's watch and listen to this video.
Welcome to Educounting, where we're passionate about financial education. Today's video is on the NASDAQ, S&P, and the Dow and what they mean. A stock market index is a calculation that gives information about a group of stocks. There are many types, and we'll cover 3 well-known U.S. indices here. It can be confusing, as the NASDAQ is both a stock exchange and an index. That means it's a place where you can trade stocks as well as a number calculated for the index as well. In addition, each calculation for an index varies because each covers different stocks and it's also calculated differently. The NASDAQ is for U.S. technology stocks, so companies which are based in the U.S. and focus on technology are included. These are stocks that focus on computers, software, and others. It tracks about 4,000 stocks and includes the technology giants like Apple, Microsoft, Google, Intel, and many others. The NASDAQ Composite Index measures the change in all the stocks on the NASDAQ. However, the NASDAQ 100 makes up the 100 largest companies. You can use this information in various ways. For example, the NASDAQ 100 has reported a 5-year return of 155%, which can be compared with other indices. The S&P 500, or S&P, is another well-known U.S. index. It is a calculation based on 500 large companies listed on either the New York Stock Exchange or NASDAQ. The S&P 500 is the most widely used because investors consider it to be one of the best representations of the U.S. stock market and the U.S. economy. The stocks in the S&P 500 are from all sectors of the economy and are selected by a special committee using criteria based on size, type, age, and more. The Dow is also one of the most important stock market indices. It represents 30 large public U.S. companies traded on the New York Stock Exchange. The calculation for the Dow is based only on the price of each share, while the S&P is based on the product of the stock price multiplied by shares. Therefore, the Dow is more commonly used by individual investors, and the S&P is used by large investors, which are referred to as institutional investors. The Dow doesn't necessarily represent minor changes, but it will show a major change when a company faces financial distress or when a broad economic shift occurs.
Okay, that's enough. I hope that you have a better idea what we are talking about right now. So let's continue with some other important information about this and how they work. So now that we understand the price or the value of a company, sometimes we will have to take decisions if we are involved into these activities. Like, for example, remember that I told you that when a company is doing really good, people want to buy. So here we have this video that is driving me crazy, actually, about good times. So when the market activity, when it's going good, we are going to have, we're going to take good decisions, or we're going to want to buy. So let's read. So trading has been heavy on the New York Stock Exchange with very high turnover of 1.5 billion shares changing hands. We've seen spectacular gains, especially among blue chips. So I'm going to stop here, and here on the right on this white section, we have like kind of translation about the bold words. So what's trading? I told you in the beginning, it's buying and selling, in this case, of shares. Shares are parts of the company. Very high turnover. Turnover is like the profits. When we're talking about large number, we're talking about big numbers. So a high profit. Okay, changing hands, being bought and sold, you know, buy and sell. Spectacular gains, that sounds really positive. So big increases in value, especially among blue chips. History of profit in good and bad economic times. So when talking about blue chips, we're talking about blue numbers or good numbers. When talking about red numbers, that's bad. Okay, let's continue reading here on the pink section. The bull market is rising prices. The bull market, like the animal, seems set to continue after yesterday's record high at the close. Dealers seem bullish and expect the Dow, you know the Dow now, to go through the 15,000 barrier soon. So when talking about record high, we're talking about highest level ever. When talking about close, you know what close is. In this case, it's the end of the working day. Just like in the movies, buy, sell, and then they finish their job and they go home. So bullish, it's something optimistic. Pay attention on the spelling because it comes from the animal, like the Chicago Bulls, the basketball team. And to go through and here we have any number, barrier. So go through something barrier, it's going to be to pass the round number off. So this is what happens when we're having a good time in the company. So company is doing really, really good. So when it's bad times, you know, you don't want that problem with you. So the best decision is to rid of this and sell it. That's how we have this little video here of this guy running away, like sell it because things are not going to be good. So there was panic selling on the New York Stock Exchange today as prices fell to new 5-year lows. We've seen some spectacular declines with billions of dollars wiping off the value of some America's best known companies and more than 10% of total market capitalization. I'm going to stop here to go to the translations. So when talking about panic selling, you know, panic is something really negative. We're talking about selling shares for any price, you know, even for $1 or 50 cents, but you really need to sell them. New 5-year lows, so their lowest point for 5 years. So in 5 years, that was like the lowest point. Spectacular declines, you know, spectacular going downs. So large decreases. It's really, really low, really going down. Wipe it off is taking off the total share value and value. And value. Then the 10% of total market capitalization is like the total value of share listed on the market going down by 10%. That's market capitalization, the market. The total value of shares listed on the market. And finally, we have bear market, which is falling prices. Again, falling comes from the word fall, so go down. Okay, and then the next part is like the bear market continues with prices set to fall further in the next few days. Dealers are bearish with many saying there is no sign of a rally. If prices continue to fall, there may be another stock market collapse or crash like the ones in the 1929 and 1987. So when talking about bearish, we're talking about pessimistic, very negative. A rally is like prices starting to rise again. They start like going up again. And stock market collapse or crash, like a car crash, like an accident, something very bad. So very serious drop in the value of shares of the market with serious economic consequences. So this is what happened in bad times. We have spectacular declines, so the company's value goes down, etc. So the best decision is to sell. Some people buy shares of companies that are going down, declining, because they think that they can fix it and make it work, and guess what? Sometimes they success. So it's not a bad idea to buy shares of this kind of companies. They're going to need like a lot of work and attention and probably investment, but you can make it work. Also, it depends on the market. Like right now, it's like, you know, we have this pandemic all around the world, so most of businesses had declines on their numbers, but hopefully they're going to start going up on time. Okay, and to finish, this video is not going to be too long. I'm going to send this to your Educai. The only thing you have to do is to complete these spaces here from 1 to 8 with expressions from A opposite. I'm going back to A opposite. It's this one. Okay, so you have some bold words like demand, index, indexes or indices, and all these 7 definitions or indexes all around the world. So read carefully and complete with the right word here, and here you have a space to write your answers. Okay, so that's it for today. I decided to use the same video or GIF with Leonardo DiCaprio because probably you remember from last class. So I wanted to create a connection between stock market class and indexes class because they are really, really connected. It's very important that you remember both. So with this we finish. I'm very happy to be back, to be working with you one more time. If you have any question, you can text me, call me, you know, like we always do. So thank you very much for your attention. Have a wonderful day, guys, and bye-bye.